As humans, we are responsible for how we treat others. In fact, we are also responsible for how we treat other living things and even our Earth. This module focuses on ethics and accountability in our organizational life. As an overview, we will review the basics of a code of ethical conduct and behaviors. Then we will clarify the differences between the terms waste, fraud, and abuse. Accountability is discussed in terms of internal and external controls and the use of financial performance auditing. The Tanzania Code of Ethics and Conduct for the Public Service offers a valuable way to think about ethics. Humans deserve to be treated with respect and courtesy, free of discrimination in any way. Work must be conducted diligently by respecting the law, the duties assigned, and the work setting. Employees should promote teamwork by helping coworkers and not ridiculing others. Excellence in service is promoted by achieving the highest standards of performance through continuous improvement. Good stewardship is achieved by safeguarding organizational assets, including money, and acting in accordance with the delegated authority and responsibilities. Transparency means being accountable for our actions and inactions through normal tiers of authority. Integrity demands adherence to rules and laws, avoiding any conflict of interest, and conducting work with honesty and impartiality. Public servants, including anyone responsible for public dollars, even if they do not work for the government, must not let political influence or bias enter into any of their work activity. Because we often hear of calls to get rid of waste, fraud, and abuse, it helps to define those terms. Fraud is a term defined in law, so check with your legal expert for what actually applies to your setting. Generally, fraud is any dishonest or fraudulent or deliberately wrongful course of action that results in an economic advantage to which the recipient would not normally be entitled. A few examples of potential fraudulent activity are offered: forgery or alterations of any document, theft, misappropriation, misuse, or diversion of money, equipment, or materials, intentional misrepresentation of a laboratory's interests, conversion, which is the use of lab equipment for non-lab business, profiting by self or others as a result of inside knowledge, payroll falsification, which would be called theft of time, or seeking anything of value from vendors or others providing services or materials to the lab for personal gain. Unlike fraud, waste and abuse often are not based in law, but rather are handled through organizational rules. Waste refers to the unnecessary incurring of costs, expenditure or allocation of resources significantly in excess of need. An example is the negligent or reckless ordering of supplies several times more than the amount required. Waste need not necessarily involve an element of private use or of personal gain, but it invariably signifies poor management. Abuse refers to violations or circumventions of rules which impair the effective execution of operations. It entails exploitation of loopholes to the limits of the law, primarily for personal advantage. An example is intentionally and unnecessarily scheduling meetings in another city in order to claim reimbursement for travel and other charges to attend those meetings. Having to answer for or explain your work is really accountability. The same goes for the organization as a whole. An overview matrix can help illustrate the points. Financial or money accountability can be based in the organization itself through internal controls, or externally based in the work of an independent agency or firm, such as an outside auditor. Performance accountability looks beyond just the money used and into the efficiency and effectiveness of the programs funded by that money. When conducted internally, performance auditing is to improve services. Higher levels of government, funding agencies, or donors may conduct performance audits with the fundamental purpose of exercising oversight on the results of the use of their money. Now we will look at each of the topics in more detail. Internal controls refer to policies and procedures on conducting business. There can be many rules that fall under this umbrella. There are controls to safeguard assets. For example, Before spending money, you typically have to get pre-approval from higher levels in the organization. You cannot just go out and buy anything you want to with their money. These controls help guard against waste, fraud, and abuse. Money from donors and/or the government typically have strings attached. That means that you can only spend the money for items that comply with the contract or terms specified in the funding agreement. You may have to submit paperwork to get pre-approval to go to a training session out of town. And then, when you return, you have to submit proof of your expenses to obtain reimbursement. At both points, someone will likely have to look over the paperwork to approve your absence, and then later to confirm that you deserve reimbursement for certain allowed expenses. Internal controls ensure that financial reports are reliable, meaning that they can be verified and that the reports show what they purport to present. Internal controls can foster efficiency through the automation of manual controls, such as the smart use of mobile phones for banking and electronic receipts. Internal controls should ensure that the records are complete, that correct amounts are recorded, that the proper authorization is obtained for each activity, and that information is available in a timely manner for decision making. Financial audits focus on money accountability. Managers prepare the end-of-year financial statements according to uniform accounting standards. The International Accounting Standards Board, or IASB, issues the International Financial Reporting Standards and the International Accounting Standards. An external audit agency or firm reviews those financial statements, supporting documentation, and related disclosures to provide a professional opinion that management has presented a true and fair view of the organization's financial performance and position. The external auditor does not look at every transaction, but rather they sample them. Accordingly, the external auditor cannot detect all fraud and errors. Performance audits focus on efficiency and effectiveness instead of money accountability. The goal is to evaluate or review programs by examining the evidence in a way that is consistent with a set of predefined criteria, such as the degree to which the program achieves its goals, how it avoids overlap with other programs, and how it has benefits that outweigh or justify the program costs. Some larger organizations have internal auditors that focus on improving the program. External program audits are often performed by independent agencies, such as at the central government level, and the review is often for oversight purposes. Donors may also conduct performance audits. A typical question of these oversight efforts might be stated as the following. Was our money used by the laboratory to deliver effective services? Answering this question requires the external performance auditor to define what an effective service is. Thus, it is about more than just the accuracy of the money. In summary, ethics and accountability are critical elements in managing the resources of any organization.